The American commercial gambling industry collected $78.72 billion in gross gaming revenue in 2025, according to the American Gaming Association. Every dollar of it came out of a building someone had to build, staff, insure, license, survey, tax, audit, and operate around the clock, 365 days a year. The house always wins is a mathematical certainty. Whether the house makes money is an entirely different question. Most people who have never run one picture the casino owner as the person at the top of a one-way funnel, watching cash pour in from hundreds of machines while doing essentially nothing. The reality is a high overhead, highly taxed, relentlessly regulated hospitality operation where the math is on your side, but the costs are enormous, the compliance burden is constant, and the margin on what survives isn't nearly as fat as the neon suggests. Before any of that becomes clear, though, you need to understand something about where that money actually comes from inside the building, because the answer isn't what most people assume. Get through the startup costs first. A greenfield casino from the ground up requires construction at roughly $700 to $1,200 per square foot just for the gaming floor itself, and that's before a single slot machine is in the room. A mid-scale regional property at around 100,000 square feet of gaming space puts you somewhere between $70 million and $120 million in hard construction cost alone, and that's before soft costs, engineering, permits, or the regulatory process. The regulatory process is where the first surprise lies. Before laying 1 foot of carpet, you need a gaming license, and the investigation behind it costs far more than the application fee itself. Nevada's non-restricted license application fee is $500. That number is almost meaningless. What the Nevada Gaming Control Board actually does is dispatch agents to investigate the business entity, its principles, its financial history, its sources of funding, and the character of every significant investor, and the applicant pays for every hour of that investigation. Complex applications involving multiple principals and out-of-state money can accumulate hundreds of thousands of dollars in investigative costs before the license is even granted. In states like New Jersey and New York, where casino licenses have been granted to large integrated resort projects, the licensing and upfront regulatory compliance costs alone have run into the tens of millions. Then there's the cage. The cage is the financial engine of the floor. It's where cash is converted to chips, where markers are issued, where jackpot payouts are processed, and where the books are reconciled multiple times per shift. Gaming regulators require that a casino maintain a bankroll, a cash reserve sufficient to cover its outstanding gaming liabilities, meaning every chip in the hands of every patron on the floor at any given moment. For a mid-sized property, that bankroll requirement can run from $5 million to $15 million, capital that is legally obligated to sit in the cage and the vault rather than being deployed anywhere productive. That's dead money, by definition. It earns nothing while it waits to pay out a lucky run at the baccarat table. The equipment itself is the next line item. A commercial-grade slot machine from a major manufacturer costs between $15,000 and $25,000 per unit to purchase outright. A regional property with 500 machines is looking at $7,500,000 on the low end just to stock the floor with hardware, and that number assumes the operator bought the machines rather than leasing them. Many operators lease, paying manufacturers a participation fee, often a daily cut of each machine's revenue, which lowers the upfront capital requirement but creates a permanent operating cost that follows every dollar the machine earns. Table games require their own infrastructure: felt chips, shufflers, specialized security cameras positioned to capture card values and chip denominations from every angle simultaneously. The surveillance system isn't optional, and it isn't cheap. Gaming commissions mandate continuous high-definition coverage of every table position, every slot machine, every cashier window, every entry point, every counting room, and every vault corridor. Footage must be retained for a minimum of 30 days in most jurisdictions, longer for high-security zones, and the system must operate at full capacity around the clock with no failure tolerance. A property-wide surveillance infrastructure for a mid-scale casino, including cameras, storage, networking, and the dedicated surveillance room that regulators often require to be walled off from floor operations management, runs into the millions before installation labor. Add physical security staff, armed guards covering the cage and vault, plainclothes personnel on the floor watching for chip theft and collusion, and the surveillance labor line becomes one of the property's larger payroll categories. A realistic startup budget for a regional casino in the 100,000 square foot range, before land acquisition, before pre-opening working capital, and before the initial cash bankroll, lands between $30 million and $150 million depending on the state, the scope, and how much of the financing is debt. Now let's talk about what happens after the doors open. The floor runs 24 hours a day. Labor costs for casino operations typically run between 21 and 28% of total revenue, according to industry research from multiple university gaming studies. That includes dealers working rotating shifts, pit supervisors, cage cashiers, count room staff, slot attendants, surveillance operators, and security personnel. It doesn't include the hotel staff, the kitchen staff, the maintenance crew, the compliance officers, or the marketing team. All of those are separate line items. Dealers are paid a base wage that varies significantly by state and by property, and their total compensation is heavily influenced by tips, which means dealer morale and table game volume are tightly linked. In heavily unionized markets like Las Vegas, the fully loaded cost of a dealer including wages, benefits, and payroll taxes can exceed $60,000 per year per employee before a single hand is dealt. A 200-seat table game section with 40 tables running 3 shifts requires roughly 120 to 150 dealers on payroll just to keep the game staffed. That's before management, before supervision, before the count room crew that processes every dollar dropped in every drop box every day. Utilities are substantial because a casino never closes its air conditioning, its lighting, or its signage. A property with a hotel component runs HVAC systems at full load around the clock for every occupied floor, every corridor, every ballroom, every restaurant. Electricity alone for a mid-size integrated property can run $2 million to $5 million per year. Now look at what those costs are working against. On the gaming revenue side, slot machines drive the floor. Industry data consistently shows that slots generate between 60 and 90% of a casino's gross gaming revenue in most domestic markets. The reason is simple. A slot machine runs continuously, requires no dealer, processes bets every few seconds, and carries a house edge that typically runs between 2.5 and 15% depending on the denomination and the market, with penny machines generally set tighter and dollar machines looser. The actual money a machine earns per day is called its average daily revenue or win per unit per day, and it varies enormously by property and location. A slot on a busy Las Vegas Strip property can pull $300 a day or more. A machine at a regional property in a mid-sized market might average $80 to $150 per day. A struggling rural property might see $40 to $60 per machine. Multiply that daily number across an entire floor of 500 machines, and the difference between a strip property and a rural competitor is tens of millions of dollars per year on the slot floor alone. Table games earn less per square foot than slots but attract a different customer profile. A blackjack player, a baccarat player, a craps player, they spend more time at the property, they eat in the restaurants, they book the hotel. They're the customer the comp program was built for. The house edge on blackjack with basic strategy runs around 0.5% to 1%. On roulette, a standard American wheel with 2 zeros, the edge is 5.26%. On baccarat, which has become the dominant game in properties with significant Asian American and international clientele, the banker bet carries a house edge of just over 1%. The margins on individual table games look thin, but volume and time on device multiply them. The revenue mix outside the gaming floor has become structurally critical, especially in destination markets. Hotel occupancy at casino resorts generates room revenue that ranges widely by property tier, from roughly $80 per night at a regional highway casino to well over $300 at a strip resort. At scale, a 1,000-room hotel attached to a casino generates its own meaningful revenue stream, one that is independent of whether the gaming floor had a good night. Food and beverage at a casino property runs a notoriously thin margin. Restaurant labor, food cost, and the structural role of comp meals mean that many casino dining outlets operate near break-even or at a slight loss as a deliberate business decision. The meal is a retention tool. If giving a player a $40 dinner comp keeps them on property for another 3 hours at a slot machine, the comp program pays for itself. The formal metric is the reinvestment rate, the percentage of gaming revenue returned to players through comps and free play. Competitive casino markets see reinvestment rates running from 15 to 30% of carded win, meaning a significant fraction of every dollar the floor earns goes directly back out as meals, hotel rooms, free play credits, and loyalty point redemptions. Retail leasing within a casino property functions as a modest but reliable income stream. Gift shops, branded retail, and in larger properties, fashion boutiques and jewelry stores pay rent that partially offsets the property's real estate overhead. It's not a significant revenue driver. It's a traffic management tool that keeps guests moving through the property and provides an incremental margin contribution. Now here's where the real pressure lands. Gaming taxes are applied to gross gaming revenue, which means before operating expenses, before labor, before debt service, before utilities, before compliance costs, the state takes its share first. Nevada applies a graduated rate structure 3.5% on the first $50,000 of monthly gross gaming revenue, 4.5% on the next $84,000 and 6.75% on everything above $134,000 per month. By major market comparison, that looks like a gift. Pennsylvania taxes slot machine gross terminal revenue at 54%. Maryland taxes electronic gaming devices at rates ranging from 42 to 58%, depending on the specific property. Those are not typos. An operator in Pennsylvania keeping 46 cents of every slot dollar before labor, before utilities, before debt service is not running a money printer. The operator in Maryland running a property at the 58% slot tax bracket is paying the state more than half of every dollar the machines collect before a single overhead bill is touched. The federal compliance layer adds its own sustained cost. Any casino with gross annual gaming revenue of $1 million or more is classified as a financial institution under the Bank Secrecy Act and must maintain a full anti-money laundering compliance program under Title 31 of the Code of Federal Regulation. This means a written compliance program with documented internal controls, a designated compliance officer, mandatory employee training, and independent audits conducted on a regular schedule. Every cash transaction at or above $10,000 in a 24-hour period triggers a currency transaction report that must be filed with the Financial Crimes Enforcement Network known as FinCEN. Every transaction that raises suspicion of money laundering, structuring, or other illegal activity triggers a suspicious activity report regardless of dollar amount. The compliance operation isn't a filing cabinet, it's a department. It requires dedicated personnel, ongoing training cycles, transaction monitoring systems, a legal relationship with outside counsel who specializes in gaming regulation, and a relationship with the IRS, which jointly enforces Title 31 alongside FinCEN. Non-compliance carries civil penalties starting at $50,000 per negligent violation and climbing to $25,000 to $100,000 per day for willful violations, plus potential criminal charges for individual executives. Systemic compliance failures have resulted in multi-million-dollar federal settlements for casinos that were found to have turned a blind eye to suspicious cash activity. That's not abstract risk management. That's a fixed line item that exists every day the doors are open, whether or not the floor is busy. The annual audit cycle is its own cost center. State gaming regulators require submission of audited financial statements. Most jurisdictions require that the auditor be a CPA firm approved by the Gaming Commission. The audit covers gaming revenue, cage and count room procedures, internal controls, surveillance compliance, and financial reporting integrity. A full gaming audit for a regional property runs into the hundreds of thousands of dollars annually. A large integrated resort with hotel, food and beverage, and multiple gaming categories might spend $500,000 to well over $1 million per year on regulatory audits and compliance filings. That number compounds across multiple state licenses if the operator holds properties in several jurisdictions. So what does the actual profit look like after all of it? Land-based casino EBITDA margins in the United States typically run between 20 and 30% of gaming revenue. According to industry benchmarks from analysts who track publicly traded operators including MGM Resorts and Caesars Entertainment, EBITDA, meaning earnings before interest, taxes, depreciation, and amortization, is the number the industry uses to measure operational efficiency before the capital structure is counted. Net profit margins after interest on construction debt, after depreciation on equipment and the building itself, after the capital expenditure cycle that requires periodic slot floor refreshes and table game replacements, compress significantly from that EBITDA figure. Regional properties with high debt service from construction loans or properties operating in high-tax states can see net margins in the single digits or below zero in lean years. The best operators in the best markets, properties running high occupancy hotels alongside slot floors in low-tax jurisdictions, can achieve net margins in the mid-teens to low 20s. The median isn't that. The variance is enormous. There's a category of cost that almost nobody talks about when they imagine casino ownership, and it's one of the largest hidden drains on a property's cash flow. Slot floor refresh cycles. Machines have a useful life. Player preferences shift with the entertainment market, and a slot floor populated with games that nobody is choosing will see its win per unit figures drop steadily while the fixed costs of operating those machines stay constant. Operators typically refresh 10 to 20% of their slot floor every year, either buying new units, leasing newer models, or converting participation agreements to keep the library current. On a 500-machine floor, refreshing 15% annually means replacing or upgrading 75 machines per year at $15,000 to $25,000 each, meaning $1,125,000 to $1,875,000 per year just to keep the inventory competitive. That capital expenditure doesn't appear in the EBITDA figure. It's below the line in the cash flow statement, and it's as non-negotiable as any utility bill. Table game equipment cycles are less frequent but not trivial. Felt replacements, chip refreshers, shuffler maintenance contracts, dealing shoes, and the occasional game format change required by regulatory approval all accumulate into an annual maintenance cost that most outside observers never account for. The path to profitability in this business runs through three things: location, tax jurisdiction, and scale. A well-located property in Nevada or a state with moderate tax rates, operating at sufficient gaming revenue volume to spread its fixed overhead across a large base, with a hotel that sustains occupancy above 70%, can generate strong returns on invested capital over time. The operators who don't make it share common failure pattern. Undercapitalization at the start, meaning not enough bankroll to absorb variance in gaming revenue during the first operating year while the property builds its customer base. Over-reliance on gaming revenue in a competitive market, meaning insufficient investment in the hotel, restaurant, and entertainment amenities that create the repeat visit cycle. and underestimation of the compliance burden, meaning walking into a highly regulated environment with a legal and compliance team that isn't proportionate to the regulatory exposure. The American Gaming Association reported $18.09 billion in state regulated gaming tax revenue from commercial casinos in 2025. That's the size of the toll booth. Every operator in every market paid through it before taking home a dollar. The house always wins is the golden rule of gambling, and it's true. What nobody says in the same breath is that after the state takes its cut, after the compliance team is paid, after the surveillance system runs another shift, after the slot floor is refreshed and the cage is fully capitalized and the auditors finish their work, what remains is the margin that determines whether this particular house, with this particular debt load, in this particular tax jurisdiction, actually made money. Some do. Many don't. The math favors the house against the player every single time. The market doesn't promise the same to the owner.